Hi everyone, my name is Varun and over the last 10 years I have been analyzing companies. Companies for the stock trading, companies to analyze their budgets, companies to analyze their performance and whatnot. So today I'm gonna tell you how to analyze companies using the ratios, KPIs and different metrics. So let's get started.
What is it that come to your mind when you heard the word ratio and KPI? What is the first image that comes to your mind? That what do you make out of ratios and KPIs? Guys, can anybody tell me what do they understand by ratios and KPIs? Guys, can you guys hear me?
Yes, sir.
Guys, am I audible?
Yes, sir.
Nobody is answering. I just want to ask, what do you understand by ratios and KPIs?
So, ratio basically help us to find the solvencies or the profitability rate, and KPIs are basically key performance indicators.
Okay. So don't you think profitability is a key performance indicator?
Yes, sir.
So what do you understand then by ratios and KPIs?
Basically, they measure the performance of a company over a period of time.
Okay. Okay. Anybody else would like to answer? What do we understand by ratios and KPIs?
Or maybe they also help us out in figuring out what we should target in future.
Not exactly. Not exactly. Anybody else would like to answer? What do you understand by ratios and KPI? Okay. So when we talk about ratios and KPIs, what we are primarily talking about are two separate things. Okay. First, let's look at ratios. Ratios is nothing but the proportion of one financial item vis-a-vis a different financial item. Okay. Now, when I say current ratio, okay, what I'm actually asking you is what is the number that you get when you divide your current assets by your current liabilities? Similarly, when I say what is your return on equity, what I'm asking is what happens when I divide your net income by your total equity? Okay. So this is what ratio means. Ratio is basically proportion of one financial term vis-a-vis another financial term of your books of accounts. But when we talk about KPI, KPI first of all means key performance indicators. Okay. Key performance indicators. Okay. Now, as the name itself suggests, what we are trying to focus upon is we're trying to look what are the key performance indicators of the companies. These can be both financial and non-financial. Now, when we talk about key financial indicators, all the ratios that we calculate can be considered under something called financial KPIs. But when we talk about non-financial KPIs, things like number of employees, okay, then let's say internally generated goodwill.
Sir, customer satisfaction.
Yeah. All these are, I mean, number of employees and internally generated goodwill is still calculable, but customer satisfaction is not calculable. But let's say number of returning customers. Okay, all these are also KPIs. Okay, but these are not financials because you're trying to talk about something that is non-financial or not related to your books of accounts. So let's say there are two people, person A and person B. They are both into food delivery business. Let's say one is Zomato and one is Swiggy. Now they approach a venture capital company like, let's say, Tiger Global, and they are asking Tiger Global to invest in their business. Now, let's say they reach the Tiger Global office, and Tiger Global's office is on 10th floor. Okay. And that is how long these two people have there for business. They're just booting up their business. They don't have any operations yet. All they have is an idea. So let's say they both start discussing they both start giving their pitch to Tiger Global. This pitch that, let's say you you enter the office of someone and you give this pitch to someone to their office in the elevator. This is known as elevator pitch. Okay, in which you talk about key performance indicators like what has been your sales growth. Okay, what has been your cash burn, then what has been your retention ratio, what has been average, what has been your average order value. Okay, what has been the number of repeat customers. So even though not all of them are financial, but they are important because they give the person, the investor, an idea into how efficiently you are running your operations. So that if in case anybody is facing any challenges when they are comparing two businesses, these ratios basically kick in, or these KPI basically kick in into the picture, and they can understand these the performance of both these business much better. Okay. Is KPI clear to everyone? What do we understand by KPI and ratios?
Yes, sir.
Okay. Now, when we talk about KPI, we are primarily talking about, in a sense, that let's say you are an equity research analyst, okay, and you are performing your analysis on, let's say, 10 companies. Okay. Now, what happens is, let's say you have done your analysis on all these 10 companies, and now you have to present your analysis to your senior management. Then what you do not take all the 10 companies in one go to them, or do not take every detail about those 10 companies in one go. You create something called a dashboard. Okay. What do you do in a dashboard is you talk about, again, key performance indicators. That's a key line items that are important for the management to understand and to take a call on. They are not interested in what is the debt repayment profile that you are following, as long as you just tell them that, let's say we have taken a debt repayment profile tenor of 15 years and repayment would be 40% in the first 10 years and 60% in the last 5 years. Similarly, they are not interested in terms of understanding what is the periodic revenue growth in terms of, let's say, every year on a daily basis. They just want to look at the larger number, that what is the revenue growth that you are picking up on an yearly basis. They are not interested in a daily basis revenue growth. So that is where dashboard comes in. Dashboard basically sums up all your key important or key performance indicators in such a way that the person who is looking at it is able to make their decisions and understand as to how the company is performing. Okay. Is this part clear to everyone, guys? Anybody has any doubt in what is KPI and what is a dashboard? Guys, is this clear to everyone?
Yes, sir, clear.
Okay. Now, as I was saying, that KPIs and ratios are very important. Why? Because let's say, I'm just taking an example. I hope you don't mind. Let's say we have our friend Ashu. Okay. Ashu is starting up a cosmetic business. Okay. Now, for starting this cosmetic business, she needs a venture capitalist fund so that she can fund her operations. Okay. Now, let's say she have decided to approach Sequoia Capital. Okay. And pitch their idea and make them understand what her business would look like and why would she need the money and how would she use them. So let's say you have got, she has got the appointment with Sequoia Capital. So say when she's trying to explain to Sequoia Capital what are the key performance indicators, how you are, how you are approaching your business and how you are meeting the demand of your business. So they might be interested in a few line items. It might be something called conversion rate. That is the number of customers that come on your website, how many of them actually turn into customers. Then average order value. That let's say you sold goods worth 10,000 rupees, but how many people bought it? Let's say 100 people bought it. So your average ticket value is, or average order value is 100 rupees. Then what is the percentage of repeat customers? that how many people are actually coming back to your website or your app to buy back more products from you, rather than once they have bought from you, they are going on some other website to buy their products from them. How many people that you have, or how many customers do you have that are coming to your website or to your app repeatedly to buy your products? Then you have average repeat order value. That of those customers that are coming to back to you repeatedly, what is the average order value that you are generating from them in terms of, let's say, usually it is higher because this means that the customers are satisfied with your product. That is why they are coming back to your website or your app again. And that's why usually an average order value is higher than the basic order value or the initial order value that the customer places with your app or your website. Then they are interested in knowing how much dry powder do you have. Okay. So what dry powder basically means is how much cash do you have on your books or cash at hand? How much cash do you have left to basically run your operations, given that startups are a lot cash burning operations. So they want to understand how much dry powder do you have on your books of accounts. Then they want to understand how much runway do you have. Runway basically means that the amount of money that you have and the amount of expenses that you have, how many days would it take for you to basically run out of money before you would need a cash infusion to run your business operations. So that is known as runway. Yeah. Yeah, Anusha, your voice is very feeble. Can you speak a little louder? Hello? Hello, Anusha, your voice is a little feeble, my friend. Can you please speak a little louder? Okay. Then let's say average time spent. VCs are very important in, no problem, Anusha. VCs are very important in understanding how much time are the potential customers or people spending on your website or on your app, so that they can understand what is your customer engagement. Okay. And the last thing that we have is retention ratio. That is, if a rival business starts up in the same field or in the same domain, how many customers are you able to retain, or how many existing customers that you have that is you are able to retain that comes on your website repeatedly for placing orders with your website. So is this clear to everyone, guys? What are key performance indicators when we are talking about a startup? And first of all, what is the difference between a ratio and a KPI? Is this clear to everyone?
Yes, sir. Yes, okay.
Hello.
Yeah.
Good morning. My name is Mr. My ID is 0395. The second jurisdiction.
Dhruv, your voice is not clear, my friend. Hello, Dhruv.
No, sir, it was a mistake.
Okay. Now, once we have understood what are ratios and KPIs, let's look at why we use it and what are the shortcomings of ratios and KPIs. So if I can call it, can I call it pros and cons of ratios and KPIs? Okay. So let's just quickly draw a table and try and understand what are the pros and cons of a ratio and KPI. So let's look at pro and let's look at cons. The pro of ratios and KPIs is that it helps you in doing very quick analysis. Okay. Now, when I say quick analysis, let's say if you have to compare two companies, okay, as you might remember, the example that I gave you that two people, Zomato and Swiggy, are approaching a venture capital fund and are asking them for funding in their business. Now, if I have to make a decision on the basis of nothing but the pitch that they are saying or the information that I can ask them quickly, I will have to rely on ratios and KPIs. Why? Because I do not have the time to get into the depth of their business and understand their business completely. Okay, so there I will depend on ratios and KPIs to understand how is it that their business is performing relatively. Why relatively? Because I have to make a choice. Let's say I am Tiger Global and I have made a choice that I want to enter into food delivery business. So there are only two options available, that is Zomato and Swiggy. Let's, for the sake of argument, say that these are the only two options that are available. So I have to make my decision, or I have to make the choice between these two people only, that is either Zomato or Swiggy. So if I have to make my choice between these two people, then in that case, I would have to rely, if I have to make a quick decision, I would have to rely on the key information points that they will be sharing with me as in terms of what we discussed about. So the biggest pro of ratios and KPIs is it helps you in doing quick analysis. That is, you are able to quickly make a comparative analysis between two companies or two products or two assets as to which one is better and which one is faring worse as compared to the other. Now, since we have talked about the pros, let's talk about the cons. The biggest problem with ratios and KPIs is it can't be seen in isolation. Now, what do we understand by can't be seen in isolation? Let's say there is a company which is in a business, let's say food delivery business again, and there are two companies in there. One of them is incurring very heavy losses, but is growing very fast. The other does not have very, very high cash burn, but is not growing very fast. So if I compare those two companies, it will not be fair on my part to make the same assumption for both companies for the simple reason those two companies are in very different stages of their life. So one company which might be burning cash very fast is burning so that it can grow in the market and can capture market share. Whereas the first company which is having a high profitability or a low cash burn, but a slower growth might be focusing on profitability. That is that they have enough, market share in the market. Now they want to focus on profitability rather than just on expanding their product or expanding their services and capture market by giving discounts. So I have to make sure that when I analyze these two companies, I have to keep this in mind that what are the different companies, different stages, what are the different business models that the companies have, and should these be seen in isolation in terms of understanding that both companies would have their own set of pros and cons, and I have to look them holistically rather than judging these two companies or simply on one or two parameters. Okay, is this clear to everyone, guys? Guys, is this point clear to everyone?
Yes, sir.
Okay. Then the next pro for this, for ratios and KPIs is it is very helpful in making future prediction. Okay. Now, let's say you're a large company like Hindustan Unilever or Indian Tobacco Company or ITC. Okay. Now, people have seen that you are a large company, you have been in business for a very long period of time. Generally, your operations are stable, your margins are stable. So it becomes very easy for an analyst who is analyzing your company to understand how your future performance is going to be. All he has to do is forecast your top line, and then as a proportion of your top line, all the line items that you have he has seen that generally, given that you're a large stable company, all your line items are usually a proportion of your income statement. When we calculate everything as a proportion of income statement, what is it called? Guys, when we calculate everything as a proportion of income statement, what is it called? We have just discussed this 2 lectures back, guys.
Sir, common size income statement.
Absolutely. Common size income statement in which we calculate every line item of your income statement as a percentage of your revenue. So as I was saying, given that there are companies which have very large scale and very large operations, it becomes easier for you in terms of predicting their future, given that you have a long history of their operations in front of you, and you tend to understand that these companies generally have relatively stable margins and relatively stable costs. So going forward also, I can keep this as an assumption, and if I want to make a prediction or future assessment or estimate about these companies, I can do so. Okay. Is this point clear to everyone, guys? How ratios and KPIs are helpful in making future prediction? Guys, is this point clear to everyone?
Yes, sir. Yes, sir.
The second con with this is that you have to look at multiple ratios. Okay. So let's say you have to look at, when I say you have to look at multiple ratios, what I'm trying to say is you cannot make your assessment on the basis of a single ratio when we talk about ratios and KPIs. So let's look at an example. let's say a company might be having very low price to earning ratio, that is its market price divided by its earning per share, but its EV to EBITDA might be or its price to earning might be very high, but its EV to EBITDA might be very low. Now, somebody who might look at price to earning might think that the company is very expensive, but when you look at the holistic picture in terms of EV to EBITDA, the number might be very low. But you have to look at both the ratios to understand or make an assessment rather than just look at one ratio. Why? Because one ratio will not give you the complete picture. You have to understand the company from every angle. So you would have to assess that company from different angles rather than just looking at it from one entity or one side. Because why? Let's say if a company has very high price to earning ratio but very low EV to EBITDA, that means that the company is using a lot of debt to arrive at their price to earning or at a higher earning rate. To arrive at that additional return on capital, they are using a lot of leverage instead of using a balance between leverage and equity and driving up their their margins or their operations. They are relying heavily on leverage to arrive at a higher return on equity. So you have to look at things from a holistic perspective rather than just looking at it from a single angle or a single dimension. Okay, is this point clear to everyone, guys?
Yes, sir, clear.
Okay. So the next con that we have is everyone interprets ratios and KPIs differently. Okay. Now, when we talk about a different interpretation, what we are talking about is, let's say if somebody calculates a value, let's say somebody calculates return on asset. Now, some people calculate return on asset with the help of net income. Some people also calculate it with the help of EBIT or operating income. Now, problem is everyone calculates these ratios depending upon their understanding of the ratio. So there's no standard formula, so to speak, given that you are trying to calculate one financial aspect as a proportion of a different financial aspect. So that's why what you have to make sure that when you are calculating ratios, you have to make sure that you are uniform across uniform across the companies that you are selecting or you are analyzing in your approach. You cannot have that you are following one approach of net income for one company and EBIT for another company. You have to make sure that you're following a uniform approach for all the companies across. Okay. Why? Because let's say if you are analyzing one company with the help of net income and the other company with a operating income, the results that you will get will be very skewed. So you have to make sure that you always apply or always follow the same methodologies for all the companies that you have under the purview of your analysis. Okay. Is this point clear to everyone? Guys, these are interview questions and very important for you to understand these points. So that's why I'm repeating again and again. Are these points clear to everyone? These three cons that we have discussed so far?
Yes, sir, clear.
Now, the next con with ratios and KPIs is you have to compare it with industry benchmark. Okay. Now, what do we understand by industry benchmark? Let's say there's a company that you are looking at, okay, and you are looking at it from different angles, and then you arrive at a decision that the company is performing very well. But then you start comparing that company with its industry benchmarks as to how other companies in that entire industry is doing or how the industry is doing on a consolidated basis. And then you realize that your company is not that good while performing or on its operating indicators. So that is why it is very important for you to understand that you have to compare your company at an industry level also, so as to make sure that all the companies that are performing in the industry are also taken into consideration when you are making a comparison between your company and industry, so that you can understand how efficient your capital allocation, your operations, your tax structuring and everything is, so that you can arrive at a better decision in terms of whether your company is performing well or not vis-a-vis the entire industry. Okay. And the last con that we have for ratios and KPIs is these raises questions rather than answer them. Okay. So what do we understand by that? What I've been saying is, let's say there is a company that you are analyzing, and suddenly you arrive at a decision that this company is not performing very well vis-a-vis its industry. So you have now arrived at a situation where you're asking for more questions, that you're trying to drill down and dig out more details about the companies rather than just understanding as to where the company is standing, so that you can understand what is the thing that is lacking in the company. Can this company be turned around if we are taking certain decisions about the operations of the company? So that is why I'm saying that ratios and KPIs basically start raising those questions or help you raise those important questions rather than simply answering those questions. They become a launch pad for you in terms of asking more important and pertinent questions to the management of the company, so that you can understand where is the company coming from and where it is heading, and is it making the right decision and right choices in its operations. Okay, is this part clear to everyone, guys? Anybody has any doubt in this? Guys, anybody has any doubt in these what we have discussed so far?
No, sir.
Okay, then let's quickly have a read on the literature that has been shared with you around this, and then we'll move forward. Okay, so please quickly read this entire section and then we'll move forward. Please let me know once all of you are done. Is everyone done? Okay. Any doubts in this, guys, before we move forward?
No, sir.
Now, let's move forward and look what are the different kind of ratios that are available for us to discuss.
Sir,
So,
ratios, sir,
sorry,
sir,
yeah,
ratios can be, yeah, sir, ratios can be calculated for multiple
Arshit, your
companies.
voice is echoing. It's not clear, my friend. Please keep the
Hello,
volume.
sir. Am I audible now?
Yeah, you're audible now.
Yeah, sir. I am telling that the ratio can be calculated for single company also, or it can be calculated for multiple companies only.
No. Of course, you have to calculate ratio for every single company to arrive at calculating ratios for multiple companies as well. There is no such concept that you can only calculate ratios for multiple companies.
Okay, sir.
Okay. All right.
Yeah.
So when we talk about ratios, guys, what we're talking about is we are primarily talking about 5 different aspects of ratios or 5 different kind of ratios. Okay. So What are the 5 different type of ratios? The first ratio is known as activity ratio, or we can also call it efficiency ratio. What we are trying to do here is try and understand how effectively the company is using its asset base to drive up its operations. Okay, we are trying to understand how effectively or efficiently the company is using its asset base or its assets to run its operations. Then you have second ratio, that is liquidity ratio. Here you're trying to understand how is the short-term financial health of the company. You're trying to understand how is the company performing in the short term financially. If push comes to shove, whether the company has enough assets and enough cash lying on its books that it will be able to meet its short term obligations. Then you have your solvency ratios. Okay, you're trying to understand how the company is set in terms of long term financial viability. How well the company is set in the long term to meet all its obligations. Okay, then you have profitability ratio. As the name itself suggests, you're trying to understand how profitable the operations of a company are. Okay, and the fifth are valuation ratios. As the name itself suggests, you are trying to value the company or valuation of a company. Okay, we will talk about them one by one and in detail and understand what are the different ratios that are available. But are these broad 5 ratios clear to everyone? Is everyone able to understand what is activity ratio, liquidity ratio, solvency ratio, profitability ratio, and valuation ratio?
Yes, sir.
Okay. Now, let's start with the first set of ratios, that is activity ratio. Okay, or as I call it, efficiency ratios, where you are trying to understand how efficient is the company's operations. Okay, and the first ratio under activity turnover ratio is accounts receivable turnover ratio. That is, you're trying to understand how effective or efficient you are in terms of recovering your accounts receivable from the market. So the formula for accounts receivable turn ratio over ratio is net sales divided by average accounts receivable. That is, you're trying to understand as a proportion of your sales, how many accounts receivable remains outstanding in the market, or how much money of yours remains stuck in the market. That is, how much cash sale you are making versus how much credit sale you are making. Okay, you're trying to understand that, let's say, as a proportion of, let's say, if you made a sale of 100 rupees, your average accounts receivable, let's say, are 20. So you are trying to understand how much proportion of your sales are you making in cash and how much of it are you making in credit. So it helps you in understanding how you are set as far as your receivables are concerned. Okay, is this part clear to everyone?
Yes, sir. Clear. Yes, sir. Go ahead.
Taking this ratio forward, once we have arrived at, we can also calculate what are our days receivable outstanding. That is, how long in terms of number of days does it take for us to convert our sales into cash. So the formula for that is 365, that is number of days in a year, divided by accounts receivable turnover ratio. That is, we're trying to understand that as a proportion of 365 days, how long does it take for you to convert your sales into actual cash? Now, if I write this as 365 divided by accounts receivable turnover ratio, can I also further expand it as 365 divided by sales into average receivables? Okay, if I want to directly calculate my days receivable outstanding, I can do 365 divided by sales into average receivables, and it will give me how long are my, in terms of number of days, how long are my receivables outstanding in the market. Is this clear to everyone, guys? Guys, is this clear to everyone?
Yes, sir. Clear. Clear.
Okay. Now let's move forward. Taking these ratios forward is accounts payable ratio or accounts payable turnover ratio. Just like you have accounts receivable turnover ratio, in which you are trying to understand how much of your sales you are making in cash and credit, you have something called accounts payable turnover ratio, in which you are trying to understand of all the purchases that you have made, how much purchases have you made in cash and how much of it have you made in credit. So the formula for accounts payable turnover ratio is COGS divided by average payables. Okay, COGS, why? Because it represents the cost, that is the amount of purchases that you have made. Instead of in receivables, just the way you have sales, in purchases you have COGS, that is how much purchases or how much goods have you purchased from the market, and divided by accounts payable, that is how much of it is payable in cash and how much you have already paid. So how much purchase you have made in cash versus credit. Okay, just like you have your accounts payable, turnover, accounts payable days, your accounts receivable days, you have something called accounts payable days as well. Okay, and formula again remains the same, that is 365 divided by accounts payable turnover ratio. Or if I have to expand this further, it is 365 divided by COGS into average payables. Okay, this formula basically tells you how long does it take for you to clear all your COGS that you have in terms of paying cash for it. How long does it take for you during a particular period for which you are calculating? How long did it take for you to basically clear all your purchases in terms of paying out cash for it? Is this clear to everyone, guys? Anybody has any doubt in this? Guys, anybody has any doubt in this, please let me know.
No, sir. Go ahead.
Okay. The last ratio under accounts under activity or efficiency ratio is inventory turnover ratio, or ITR. Okay, just like you have your accounts receivable and payable turnover ratio, you have something called inventory turnover ratio as well, where you are trying to understand how much proportion of your cost is lying in the form of inventory and how much proportion is lying in the form of raw material. So the formula for this is COGS divided by average inventory. Okay, you're trying to understand that of the total costs of the total cost that you have incurred, how much to basically acquire the raw material, how much of it has been converted into finished goods, so that you can understand that how much finished products you have lying with you, if in case tomorrow you have to sell those products in order to raise cash, or how efficient are you in terms of how much proportion of the cost or raw material that you have received you keep it converted into finished goods for selling. Just like you have your accounts payable days and accounts receivable days, you have inventory days as well. Okay, the formula for inventory days again becomes 365 divided by inventory turnover ratio, or 365 divided by COGS into average inventory. Okay, is this clear to everyone, guys? Anybody has any doubt in this? Guys, is this clear to everyone? Anybody has any doubt in this?
No.
Okay.
No, sir.
Okay. Let's do a quick read around the literature for this and then we'll move forward. Okay. Please quickly read this and let me know once you're done reading up until here. Done? Can I scroll through?
Yes, sir, done.
Just give me a minute, guys. Yeah. Please let me know once everyone is done with this page. Done?
Yes, sir.
Okay. Let's talk about a few more ratios around turnover ratio and then we'll move forward. The next ratio that we would talk about is total asset turnover ratio. Okay. What we're trying to understand is that how efficiently the company is using its entire asset base. Okay. So how efficiently the company is using its entire asset base to generate revenue. So you are generating revenue and you're trying to understand how efficiently the company is using its total asset base to generate these revenue. Usually, the companies that have this ratio of more than 1 are considered to be good. That is, they are using their assets optimally to generate the revenue. Higher the ratio it is, the better it is that in terms of how efficiently the company is using its asset base to generate the revenue. Now, just like you have your total asset turnover ratio, you have something called fixed asset turnover ratio also. Okay. Again, the formula remains the same. That is, you want to understand how effectively or efficiently the company is using its fixed assets to generate revenue so that you can understand how efficient or effective the company is in terms of using its fixed assets. Again, the ratio of greater than equal to 1 is considered to be a good ratio. Okay. The last ratio that we will talk about under this is working capital turnover ratio. Okay. In this, we are trying to understand that as a proportion of your revenue, how much money do you need in terms of working capital to run your business efficiently. Why? Because a working capital is required for your day-to-day operations, and revenue is the source of money that you have for your business operations. So you're trying to understand that as a proportion of your revenues that you are generating, how much money do you need as a proportion of your revenue to run your day-to-day business? Are these pointers clear to everyone, guys? Anybody has any doubt in this?
Sir, in total assets revenue turnover, it is greater and equal to 1 or only
Yes,
greater
yes.
to 1?
No, greater than equal to.
Okay, sir.
Okay. Guys, is this part clear to everyone? Activity and turnover ratios clear to everyone? Anybody has any doubt in this?
No, sir, clear. It's clear.
Okay. Then let's do one thing. Let's take a quick 10 minutes water break here. We'll meet on the other side. If anybody has any doubt, then we'll first discuss those doubts and then we'll take it forward. Is everyone okay with the plan?
Yes, sir. Yes, sir.
Okay. Let's meet in 10 minutes. Is everyone back?
Yes, sir.
Okay. Then let's take it forward. So let's do a quick exercise now. Okay, let's do a quick brain teaser in terms of understanding where we are. And if somebody asks us these questions in the interview, what should our answer be? Okay, so let's look at all these three turnover ratios. That is average payables, average receivables, and average inventory. Okay. Okay. Look, now let's say, what do you think would be the implication that if your accounts payable are too high, what do you think would be the implications are for your business if your accounts payable are too high? Guys, we have just discussed what they are. Can anybody think what would be the implications if our accounts payables are too high? Guys, think about it. What do you think would happen if your accounts payables are too high? Harshit, what do you think? Nishant, what do you think? Am I audible, guys?
Yes, sir. Audible.
So who will give me the answer? What would be the implication if your accounts payables are too high?
The business is good as per ratios.
Business is good as per ratios. Okay.
Yes.
Anybody else? Nishant, what do you think? Akshay, what do you think? Anusha, Ashu? Okay. So if our accounts payable are too high, guys, that means that we have too much.
Sorry, sir. I cannot hear you.
Hello. Can you hear me now, Harshit? Hello.
Yeah, I can hear you now, sir. Yeah.
Okay. So I'm
What
asking.
was, sir, your question? Yeah.
Yeah, the question is, what would be the implications if your accounts payables are too high?
Sir, higher the liability, sir, if our accounts payable too high.
Okay. Okay.
Yes, sir.
Absolutely. Yeah.
Mhm.
So guys, if your accounts payable are too high, that means you are not paying your or repaying your payables on time. And
Yes, sir.
means that it will be difficult for you to get further credit from the market. Also, if your account, but if I have to look it from a flip side, if your average payables are high, that means your creditors are ready to give you a long lease in terms of when you will be able to repay them back. So you have to look it from both angles. That is, if you have too high a payables, that means it will be difficult for you to raise any further credit from the market or buy any further goods from the market on credit. But on the flip side, that means that if your accounts payable is high, that means your creditors have enough trust in you that they are willing to give you a long lease of line in terms of that you can pay after them to them after a long period of time. Now, what would be the implication if accounts payable are too low?
So low the liability, and we are good at market. Like we don't have that much liability, sir.
Okay.
Yeah.
Okay. But on the flip side,
On the flip side, that we don't have that much credibility. That the
Sir, it indicates the negative cash flow.
yeah,
it
that we
indicates
don't
the
have that
negative.
much credibility, and the suppliers is not providing us that much amount or goods on credit, sir. Basically, on a flip side, sir.
Okay. Okay. Anybody else?
Or sir, that may be also possible that we don't need that much amount, sir.
Okay. Okay.
We
Anybody
are
else,
good.
guys?
Sir, this means that cash has actually been paid to vendors or suppliers,
Okay.
and therefore the company has less cash.
Payables is not exactly debt, my friend, but I get where you're coming from. Okay. Payables is not exactly debt. Anusha, what do you think? Anusha, can you hear me? Okay. If you have too low a payables, guys, there are two implications to that or two sides to that. If you have too low a payables, that means that you are quickly paying out your payables or your credit purchases. That is on the positive side. But on the negative side, if you are paying out your payables too quickly, then in that case, the cash that would have left on your books, you could have generated some additional return on that cash. But since you are paying out cash very quickly, that means cash is not staying on your books for a very long period of time. So that will be the flip side, that you could have generated an additional return on that cash, but since you are paying out your payables very quickly, that cash is no longer available and you are having a low return on that additional cash that you could have generated. Is this clear to everyone, guys? What are the
Yes, sir.
implications? If you have accounts payable that are very high and very low?
Yes, sir. Got it. Got your point.
Now let's talk about receivables. What would happen if in case you have very high receivables? What do you think would be the implications of that?
Sir, higher the assets, sir. On a asset side,
But what good would that asset do to me?
means sir, we are going to receive higher amount from the receivables,
Actually,
sir.
think about it for a second first.
Sir, we will have.
Neha, you're not audible. Can you please come again?
Sir, we will have less amount of cash.
Okay. Okay. But on the positive side,
your sales will have increased.
sorry?
Your sales will have increased because you'll have revenue as much as the money has been tied down to people, to your debtors.
Absolutely. Sylvia is absolutely correct. So if you have high receivables, there are two aspects to it. One is that you are not generating enough cash in terms of your sales that you are making. But on the flip side, it can also be said if your receivables are high, that means that your sales are increasing. And since you have enough elbow room for your debtors to be provided, sales or products on credit, you are doing that. But you are generating additional sales with that. Now, let's talk about if your accounts receivable are too low or your average receivables are too low, what would be the implication of that? Dhruv, what do you think this time? Dhruv will answer the question. Dhruv, go ahead.
Sir, if our average receivables are low, then we are getting adequate cash flow, sir, from our
Okay.
customers.
Okay. Is that a positive or a negative?
So it is positive. We are getting cash.
Okay. And what would be the negative implication of having too lower receivables?
Negative implications can be.
Sorry. Can you please come again?
So for, I don't think of any negative implication for low average receivables.
Okay. Anybody else would like to think of a negative implication of having low receivables, guys?
Sir, we might not be having enough sales.
Absolutely. So if you have too low receivables, that means there might go an impression in the market that you are not ready to sell enough on credit, which might result you on losing on some of those sales that you could have made if you were willing to sell your goods on credit. Okay, is that clear to everyone now? What are the implications of very high and very low receivables, guys?
Yes,
Guys,
sir.
it's clear to everyone. Okay. Now, what do you think would be the implication if your inventories are too high? This time, Yug would answer. Yug, what do you think?
Sir, I didn't hear you.
So I'm saying, what would be the implication if you have too much inventory on your books?
Sir, one could be that we are not able to make enough sales.
Okay. Okay. Is there something else, do you think?
No, sir, I can't think of any as of now.
Okay. Prabhat, what do you think?
Excess amount of inventory basically means that the company is unable to perform its sales, and as well as it has accumulated over a long period of time. So,
okay. And what would be the implication of that?
So
think about
basically, the stocks will get accumulated over a period of time.
It will reduce profit.
Worn out. So this will definitely company profitability.
Okay, Harshit, you were saying something. Can you please come again?
Sir, it will reduce profit.
It will reduce
Profit, sir. Profit.
Profit. Okay.
Yeah.
Okay. Would anybody else like to think what would happen or what would be the implication if you have too high an inventory, guys?
Sir, we won't have enough liquidity, like as in cash.
Okay. Okay.
We don't have enough sales.
Sorry. Please come again, Neha.
We don't have enough sales. I mean, if we have more inventory, that means our sales are not as good as we have stocks.
Okay. Okay. And what would be the implication of you not being able to sell enough in the market but having high quantities of goods? What do you think?
Persons who want in wholesale can attract. We can say ki.
Okay. So if you have very high inventories or lying on your books, guys, there are 2 or 3 things that you need to keep in mind. That means clearly you are on the negative side, you are not able to make enough sales in the market, and this might result in obsolescence. So the answer that I was looking for is, if your goods remain on your books for a very long period of time, your goods might become obsolete. Why? Because newer and fresher quality or quantity of goods might arrive in the market. But on the flip side, if I have to look at the positive side of it, if there is any potential sale that might happen in the market, you have the ready goods available with you, and you will be able to push your goods in the market. Why? Because you have them readily available in your inventory. Now, what would happen or what would be the implication if your inventory is too low?
So we are not able to match our supplies, sir, basically. Demand.
Okay. Okay. On the positive side?
Sir, we are generating enough sales.
Absolutely correct. So we are quickly converting our inventory into sales. That is, our inventory is not looking at any obsolescence. And whatever inventory that we are converting into finished goods, we are able to push that out in the market very quickly. But yes, on the flip side, if there's a large demand that is coming in and we do not have enough inventory lying in our books, or in our godowns or in our warehouses, we might not be able to take advantage of it. So is this part clear to everyone, guys? If anybody asks you these interview questions, would you be able to answer these questions?
Yes, sir. Clear.
Okay. Now, when we talk about, we have already talked about efficiency ratios and that, days turnover ratio that are associated with it. If I have to look at the entire working capital days, if somebody asks you what is the formula for your working capital days, then the formula for that would be your average receivable days plus average inventory days minus average payable days. That is the money, the assets that you have to receive in the number of days, and what you have to pay in terms of number of days will give you your working capital days. That is how long does it take for you, or how many days of working capital do you need to basically run your business. Okay. All right. Let's move forward. So we have already talked about turnover ratios and efficiency ratios. The next set of ratios that we would talk about today is profitability ratios. Okay. Now, as the name itself suggests, profitability ratio talks about how profitable your operations are in terms of understanding how much return are you generating in terms of the goods and services that you're selling in the market. So you're trying to understand what is your profitability. So we look at profitability at different levels of income statement. Okay, the first level that we look at it is gross profit. Okay, the formula for gross profit is, who will tell me the formula for gross profit?
Sir, sales minus cost of goods sold.
Absolutely correct. So it's sales minus goods sold. And if I have to see how profitable my gross profit is, it will be gross profit margin would be gross profit divided by total sales. Is this clear to everyone? Anybody has any doubt in this?
No, sir.
Okay. Then the next set of profitability that I look at, operating profit margin. So the formula for operating profit is sales minus COGS minus SG and expenses. This will give me my operating profit. And if I have to calculate operating profit margin, it will be operating profit divided by net sales. Anybody has any doubt in this, guys? Guys, is there any doubt in this formula? Guys, am I audible?
No doubt, sir.
Okay.
No doubt. Hmm.
The last set of profitability ratio that we look at is net profit margins. Okay. The formula for this is sales minus COGS minus SG&A minus non-operating expenses. This includes interest, D&A, and tax. Okay. Once you have arrived at your net profit, to calculate net profit margin, the formula is net profit divided by total sales. Okay. Is this clear to everyone, guys?
Yes, sir.
Okay. Now let's do a quick reading and then we'll do a quick problem to solve. Okay. We'll solve and understand how these ratios are calculated at the different levels of your income statement. So let's have a quick read around this and then we'll take it forward. Everyone done? Can I scroll through?
Yes, sir.
Please read up until here only. Please let me know once everyone is done.
Sir,
Okay, is everyone done?
Yes.
Okay. All right. Now let's look at an example. First, let's look at where do all these line items stack up in an income statement, and then we'll solve a problem to understand the different profitability ratios. Okay. All right. So how does our income statement look like? We start at sales and we subtract COGS. That's how we reach to gross profit. So we have seen what is gross profit, how we arrive at gross profit. When we divide gross profit to us from our sales, we get a gross profit margin minus SG&A expenses. When we reduce our SG&A expenses, we reach to something called EBITDA. Okay. Then you reduce your depreciation and amortization from it. We reach to something called EBIT. This is called operating profit. Okay. When you want to calculate operating profit margin, you divide EBIT by your total sales. Then you reduce your interest expense from it. Okay. Then you reach to profit before tax. Then you pay taxes from this. You reach at profit after tax. Or some people also call it net income. When you divide this net income by your sales, you arrive at net income margin. Okay. The peculiar or the interesting thing about this is, guys, when you will calculate, let's say, two ratios, those two ratios would be the total of the third ratio above it. So what do I mean by that? When I divide my sales by sales, I will always get 100%. Anybody has any doubt in this? If I divide my sales by sales, I will always get 100%. Guys, yes, no, maybe.
yes, sir.
Okay. Then when I calculate COGS, okay, and I calculate gross profit. So if I calculate how much does the COGS calculate as a percentage of sales and gross profit calculate as a percentage of sales, if I add all these two up, it will always add up to the third line item above it. Okay. Let's look at it with the help of an example. Okay. So let's say there's a company A. It has sales of 100, COGS of 20, gross profit became 80, SG&A of, let's say, 30, EBITDA became 50, interest was 10, profit before tax was 40. Then taxes were again, let's say 10. Your net income has become 30. Now let's calculate it. So sales as a percentage of sales is 100%. COGS as a percentage of sales is 20%. Gross profit as a percentage of sales is 80%. So if I add these two, I will arrive at the previous line items value, that is sales as a percentage of sales has become 100%. So here, if I add the margin of COGS and gross profit, the number should always add up to the proportion equivalent of the previous line item. Similarly, here we have an SG&A expense of 30. So this is 30% and EBITDA is 50%. So if I add these two up, this will always be equal to the previous line item, that is gross profit. Similarly, this is interest is 10, so this is 10%, and your profit before tax is 40, so it becomes 40%. So if I add these two up, it will always be equal to the previous line item, and so on and so forth. So this becomes another check when you are creating your common size income statement. This becomes another check for you that you are calculating your numbers correctly. Sorry about that. That is, when you add the proportion of the two line items, it will be the total of those two line items would be equivalent to the total of the third line item right above them. Okay, is this clear to everyone, guys?
Yes, sir, clear.
Okay. Now we will have to calculate. We have calculated a similar problem earlier also. To understand our margins and our profitability, we will calculate a similar kind of problem once again. So you have two companies, that is company A and company B. Okay. You have sales of 2,000 crores each for both companies. Then you have to calculate what would be their COGS and their COGS margin when their gross profit margin is 50% for this company and 40% for this company. You have to calculate COGS margin and gross profit in terms of absolute when your gross profit margin is 50% and 40%. Once you are there, then you have to calculate your SG&A expenses when your EBITDA margin is 30% and 25%. Once you have calculated your EBITDA and your SG&A expenses, then you would have to calculate your depreciation and amortization, which as a percentage of sales is 10% for both these companies. Okay. Then we move forward. We will arrive at something called EBIT. You would have to calculate EBIT. Once you have calculated EBIT, you would have to calculate your interest expense, which is, let's say, 3% of sales. Okay. Once you have that, you would have to calculate your profit before tax, your tax expense, when tax rate is 25%, and that after that you have to calculate your profit after tax. Okay. All of you have 10 minutes. Please start, and then we'll discuss the solution to this problem. Okay. Please start. This is the problem that you have. All of you have to calculate this.
Tax is 5%.
25.
25%. Okay.
Please let me know once everyone is done. Okay, we have our first answer. Is everyone done? Is everyone done, guys? Guys, am I audible? Is everyone done? Can I get a confirmation from everyone? Can we start? Okay, let's start. Please, all of you also check your tally your answers simultaneously so that if in case somebody is missing, they can also check. Okay. So we have two companies, company A and company B. Let's bifurcate them. Okay. Their sales is 2000 crores, 2000 crores. This is a stated fact. Then we have not been provided with COGS, but we have been provided with a gross profit. So gross profit margin is 50% for this company. So it will be 1000 and 40% for this. That means 800. So I can back calculate my COGS. That is 1000 here and 1200 here. Similarly, I can also calculate margin. It's 50% here and 60% here. Any doubts in this?
No, sir.
Okay. Then we do not have SG&A expenses. We have to calculate that. We will leave that aside. We have been told that the EBITDA margin is 30% and 25%. So 30% is 600 and 25% is 500. Okay, I can back calculate. My SG&A expenses are 400 here and 300 here. Okay. Then we have been told that depreciation and amortization is 10% for both these companies as a percentage of revenue. So 200, 200. Then I can arrive at my EBIT. EBIT would be 400. Just a second. 400 and 300. Okay. Then we have our EBIT. We have been given that interest expenses is 3%. Interest expense is 3%. So it will be 60, 60. So we arrive at our profit before tax. It will be 340 here and 240 here. Moving along. Then we have been told that the interest tax expense that we have is 25%. So 25% of this will be 85 and of this would be 60. So we would arrive at 5, 3, 5, 255 and here it would be 180. So have everyone got the same answer? That is your net income is 255 for company A and 180 for company B.
Yes, sir.
Anybody has any doubt in this, guys? Please let me know.
No doubt.
Okay. Then let's do one thing, guys. Let's stop our session today here itself. I would request all of you to please go back home and revise everything that we have discussed today. We'll start our session tomorrow with picking up those doubts that you have tomorrow. If in case anybody have any doubts from our session today, we'll pick up those doubts for the first 10 minutes and then we'll take it forward. Also, I would request you to please spend some time on the PDF literature that has been provided to you. And if anybody has any doubts in that PDF literature, we will pick up those doubts as well tomorrow. Okay, is everyone okay with that?
Sir, when we have account doubt solving.
We will have, I'll just check. We will probably have your session accounting doubt session today or tomorrow. I'll just quickly check and you will get that intimation by email.
Okay, sir.
Okay. All right, guys. I'll see you all of you tomorrow. Take care and have a happy Saturday, all of you. Bye-bye.
Thank you, sir. Same to you, sir.
Thank you.